My name is Alan Featherstone. I am the department head of agricultural economics, and we're glad to welcome you here. In terms of a brief summary on the department, we're getting ready for school to start on Monday. The department will be right at 500 undergrads, and so we'll have a record number of undergrads in terms of new students that we're bringing in. We'll have roughly 130 new faces on campus this fall in agricultural economics. The market is good for agricultural economics. We're still placing roughly 98% of our students. The starting salary was right at $45,000 for the latest information. So certainly it is a good major to be in. This year we decided to have a theme. And in some respects, we're partnering with Kansas Wheat on this conference. We were fortunate to obtain some funding from RMA to help fund part of the conference this year. And the topic is going to be dealing with drought. In the spring, when we did this, I kind of indicated, I'm sure when we start printing this title, it's going to start raining. And it did. And so in some respects, you can be assured that we will not have a global warming conference in August. Otherwise, we might get that August freeze in Kansas. And that's kind of a little bit of accuracy with regards to economists' predictions in terms of we start talking about drought and it starts raining. So I guess we should have done this conference 2 or 3 years ago. It probably would have been good for a lot of the Kansas operations. The first session this morning is going to be the outlook. We're going to have the livestock outlook and the grain outlook. The livestock outlook will be presented by Glynn Tonsor. Glynn is a faculty member in the Department of Agricultural Economics at K-State. He received his master's and PhD from Kansas State. He originally is from Missouri, grew up on a farming operation in Missouri, and he was at Michigan State right after his PhD, and we were fortunate to hire Glynn back probably about 5 or 6 years ago to the department. After Glynn is finished, we will move into the grain outlook. The grain outlook will be by Dan O'Brien. He's also a faculty member in the department. Dan is located at the Northwest Area office in Colby, Kansas. Dan got his BS and master's degree from the University of Nebraska-Lincoln, then his PhD from Iowa State University. Dan has been here for several years. He's participated in this, so probably not maybe quite all of 20, but probably a share of the 20. And so we're glad to be able to listen and understand what their thoughts are on the livestock markets and the grain markets. And so with that, we'll turn it over to Glynn Tonsor.
Well, thank you, Alan. Can everybody hear me fine? Yep, that's good. Thanks, everybody, for coming. We have a good turnout. It's my pleasure to kind of kick us off this morning. For those of you that have been here before, you know my standard approach to this. But those of you who haven't, I'll give you a quick debriefer. I've titled this a Livestock Industry Outlook Overview. It's going to be beef cattle heavy. I think that's most germane for the state. When I get to the back half of our presentation, I'm going to talk multiple meats. So in particular, I'm going to talk about where pork supplies and broiler supplies fit in this story. I highlight that because obviously I'm going to have more cattle price slides and so forth here than other species, but feel free to ask me questions on anything. I have no problem telling you if I don't know or I don't have an educated guess. So as long as we're civil, there is no such thing as a bad question. The other thing I will tell you is the handout has a slightly older version of these slides. The core content's the same, but in true academic economist fashion, I updated the numbers this morning. So the final version will be online. So if you see some things that are a little different than the hard copy you're looking at, that's simply because the new version will be posted and you can get that online. To give you a synthesis of kind of what's going on in the beef industry, I always like to start with this particular slide. And again, as all economists do, I think I can explain everything from the supply and demand side. I think I can tell you everything that's going on in the beef industry with supply and demand. That's probably not 100% accurate, but that's how we operate and we try to do it. On the supply side, we still are in a period, although it's wrapping up, of what we would historically call tight supplies. And very narrowly, we have a lot fewer animals in the supply system than we used to. We've been offsetting that by putting more pounds on every animal, but the net amount of beef that's being produced in the U.S. is historically low. But we're at a tipping point in that story, and I'm going to drive that point home today. We're in the process of herd expansion, which leads to more animals, which leads to more pounds. Okay? So the aspects of this broader, what the economics in the industry look like that are tied to tight supplies is almost behind us. I'm not ready to say it's 100% behind us, right? So we're still going to work our way out of that. But the tone of that discussion is going to change over the next 2 or 3 years because we've started the expansion. On the demand side, things have been very good since the Great Recession, right? So really since 2010, annual beef demand, the way I quantify it, has been very strong in the U.S. And that's important to appreciate because the record cattle prices you've observed the last couple of years are a function of not just the tight supplies, but also consumers paying more per pound than some of us, quote unquote, expected. If you have strong demand and tight supplies, that pulls prices of everything in the industry up, and that in general is what we've observed. Okay? That's important to keep in mind because as we go forward, if I sound like a broken record, it's on purpose. The importance of demand is going to become very clear over the next 2 to 5 years as the tight supply part of the story falls to the side, right? There's a lot of people that think tight supplies have been the only reason cattle prices have been high. I would argue it's that and strong demand, and if we don't maintain strong demand, there's going to be an even larger fallout, right, price-wise from larger supplies. So monitoring that and appreciating that is going to be very critical as we go forward. On the very bottom, when you add all this up, you have either heartburn or excitement, depending upon your view of what's going on in the industry, maybe depending upon your age, your equity position, lots of different things, right? How many of you in the room are lenders of some sort, or at least at times wear a lending hat? Okay? How many of you are real excited to be making loans for $3,400 heifers? Do I need to repeat it? Why aren't there some hands up, right? I mean, they give some heartburn to some lenders, right? Now, the flip of that would be is, and I won't ask the parallel of this, is there's probably somebody in the room that is anxious to be expanding their herd because they like the output price part of the story and they think there's money to be made. So heartburn or excitement throughout the industry. Okay? I have a lot of slides here. I'm not going to belabor any of them as long as I just did that first slide. I like to give us a synthesis and then go into the details as we go forward. I'm going to take us from cow-calf and work my way to the consumer. So we're kind of going to follow the process of beef production, if you like. This first slide is one of several that I get from LMIC. So Livestock Marketing Information Center is a group out in Denver. I want to give them credit because they format these slides. I bring them to you and try to tell the story rather than build the slides per se. And I also want to highlight to you how to read them because they're all set up kind of the same way. The red line is a prior 5-year average, and that is 2009 through 13. The dotted kind of dark blue line is last year's 2014 numbers in all these charts, and then the solid or lighter blue line is the 2015 to date numbers. That format will hold on all these slides as we go forward. This particular one is the 4 to 5 weight price slide for calves in the Southern Plains, and the main point I want to make here is most people, including myself, think that the high in terms of calf prices was set in the fourth quarter of 2014. And you can see that over here on the right-hand side. The laser is a little bit weak, but we peaked right there, astronomically higher than the prior 5-year average, right? So anybody that sold calves last fall probably got a higher price than they thought they'd ever observe. Most of 2015, we've been higher than 2014, but you can see those lines have crossed. So here in July and August, depending on the price series we look at, we have cheaper prices than last year. Going forward, and it's implied by the projections I noted at the top, is the board, futures market, is implying that the fourth quarter of 2014 is probably going to be lower, or fourth quarter of 2015 is probably going to be lower than 2014. But it's very important to appreciate that doesn't mean the sky is falling. Right? Prices are probably going to be lower, and I'm of the camp they're going to be lower the rest of this year than they were last year. But most people I talk to are also very much of the camp that they're going to be the second best we've ever observed. It's just 2014 was the first best we've ever observed. Okay? So cow-calf returns, for anybody that has average cost, are very good. And one of the reasons they're very good is not just the output price side, which is what the previous slide was about, but on this slide. Right? Pasture conditions around the country, save California and Nevada for a moment, but in aggregate for the country, are in really good shape. So on this chart, you actually want lower numbers because this is the percentage of range and pasture that's in poor or very poor condition. So low number is good. 2015, those are really low numbers, both compared to last year and from a historic perspective compared to the prior 5 years. Why is this germane? This means it's feasible from a grass perspective to restock and start expanding the herd. And we observe that in many ways around the country. That leads us up to this slide, which is a margin slide. It gives us a barometer of returns for the cow-calf sector. Narrowly, it was returns over cash cost, again, pulled together by LMIC for a representative Southern Plains cow-calf operation. I've put the purple on there because I always joke saying I like where my W-2 comes from. That's easy to do when we're sitting here on campus. But I also do it to give you some context on how to read this chart. Is I've put that line at about $150 because we used to look at $150 return over cash cost as the good years. And you can see 3 years on there, 2004, 2005, and 2013 almost hit it. That would have fit in that. Those were good years compared to most years in this series. Well, we blew that out of the water in 2014. Per this estimate, over $500 return over cash cost was realized for a typical Southern Plains cow-calf guy in 2014. And 2015, yes, it's going to be lower. Yes, that bar came down. But context is important. That 2015 projected bar is still north of $400 when the norm for a good year was $150. Okay? So there's still a lot of excitement in the cow-calf sector. And that, of course, leads us to this chart. I could have brought to you 30 slides showing that the herd is expanding. I brought one because I think that's probably sufficient for this, but we can talk more about this in Q&A if you want. But people are holding back heifers, and they're doing it at an astronomical rate relative to the size of the herd. Okay? So we're starting from a small base of the herd. That's important. So to give some context to that, this chart right here says how many heifers are being held as beef cow replacements per the July cattle inventory report. And what I've done is I went back in time and I calculated how that current number is compared to the year before. So it's simply a year-over-year change in the number of heifers that are being held. The 2015 number is up 6.5%. So we're holding 6.5% more heifers than we did this time last year. That 2014 number was up 9.5%. And the third year, which is largest since 74, was all the way back in 1992. The reason I'm highlighting this is going all the way back to the early 70s, 2 of the 3 largest years of heifer retention are this year and last year. Okay? So I'm a firm believer that heifer retention and efforts to expand the herd is well underway, and we have multiple years of that ahead of us, particularly if it keeps raining. That doesn't mean margins will be as good as they are now. We can talk about that in Q&A if you want, but I'm pretty confident we're going to keep adding females to the breeding herd. This slide right here, I included to give you some context on where we're at in terms of, quote-unquote, the cattle cycle. Some of you have heard me talk about, I think the discussions about cycles are a little overdone, but it helps relate where we're at in terms of expanding or contracting production. And this goes all the way back to 1938. So there's been multiple cycles, and I want to make a couple points here. Most cycles have went 8 to 12, one of them 14 years. That's a typical, quote-unquote, cycle from when we start expansion to when we kind of shrink the herd and we start all over again. Okay? The most recent cycle, which is the 2004 to 2014 period, you can see up there, ended supposedly in the 2014. And the blue line, for those of you over here, we just started. We're going into, if you like, ending the first year, getting ready to start the second year of this newest cycle. I mainly put this up here for you that, to give you some context, it's normally a 3 to 5 year expansion time period, and then a 2 to 5 year decline period before we start the process again, just based on history. We're on the early part of this, right? Coupling that with cash in the pocket of a lot of cow-calf operators, if it keeps raining, I'm pretty confident we're going to keep adding heifers and females in general to the breeding herd. Okay? The last thing I'll share with you on the cow-calf side is there's a lot of folks that are pretty happy with the calf price that's available to them. There's also a lot of folks that are worried about, I won't call it a crash, but a pullback in the market over the next 2 to 3 months. And I mainly want to highlight a tool that's on our Ag Manager website that would be helpful either for you as a producer or for those of you that were a lender and raise your hands. If somebody's asking you these questions, it might be helpful for you. The tool is called Feeder Cattle Risk Management Tool. It's an Excel-based tool where you can plug in basically what the current expectations and output prices are. It's built so you can compare buying put options, LRP insurance, futures hedges, or a cash strategy. So you'd see what the expected net selling prices are under those alternative approaches. I highlight that for you because there's nothing guaranteeing that these good prices will hold. And for somebody that has heartburn about that, that's wanting to offset some of that risk, you can use this tool to basically figure out what it's going to cost you to offset that risk. I mainly just want to highlight your attention to that. I'm real quickly going to talk about the stocker segment. That's a big deal here in Kansas. It's very common. We run a lot of stockers through the Flint Hills in particular. This is just an example to give you a snapshot on the projected margins. And I mainly just want to call your attention to the resource here so you can use it throughout the year until next time we convene at this meeting. At the very top, there's a resource called beefbasis.com. Kevin Duvetter, which most of you know, worked a lot with a group out of Wyoming to build that. It's still there, and behind the scenes on Ag Manager, we use that a lot. What I did this morning was just do one hypothetical. Let's say you use the Salina market, or maybe you reside somewhere near Salina. I have good prices for Salina, is why I'm using them here. And you think you're going to buy a 550-pounder here in the middle of September with the intent to put 200 pounds on and sell sometime right before Christmas. So that's a hypothetical just to give you some context, okay? In that case, you're going to put 200 pounds on, average daily gain 2.1. The value of gain per this projection exercise, so we're projecting what you got to pay for the animal and what you're going to be able to sell it for, is $104 per hundredweight, okay? Point number one is use this resource to get that estimate, right? Just to have some context. Doesn't mean you have to agree with it, but it gives you something to assess in your head. And then ultimately, you got to compare that with cost of gain. So I just made up $80 at the bottom. Cost of gain is all over the board around the industry, so I hope if you're a stocker operator or a Linda one, they know what their costs are. So if you know it's 80 or 85 or something, you change this. But if it's cost of gain $80, then that means the expected profit of this is roughly $50 per head, if you just do the crude math, which isn't a lot. Yes, it's positive, but it's not a lot. And in relative terms, if you recognize you're going to tie about $1,300 up to get that $50, from an ROI perspective, it's pretty small. So I'm not trying to talk anybody out of doing this. My main goal here is to let you know those margins have been better at other times, right? In particular, better as a percentage of your money that's tied up, because it takes a lot of money to do this, right, to buy those expensive calves. What's the parallel outlook for feedlots? 2015 has been rough. That's a really scientific bullet point to put up there. Those of you that raise your hand as lenders are probably exposed to that, at least some of you. You're well aware of that. Some of you in the room that operate as feedlots, you're aware of that. It's been a tough run, and 2014 was a better surprise run than we expected. So in some sense, I was wrong on, I thought 14 would be rough, and it was really good. I thought 15 would be rough, and it's probably been even worse than I thought it would be. So in some sense, I've been wrong on both. I continue to have a lot of concerns on basically the structural makeup of the feedlot segment. I know I sound like a broken record with this, but there's still excess capacity. We haven't resolved that, and as long as you have more physical infrastructure in an industry than you need, it's hard on margins. We're still fighting through that. Here's a slide just to call your attention to another resource. Every month, I put out both a historical and a projection of returns for the feedlot industry. At the bottom, I've put in bold. I would encourage you to use this as a barometer of trends, because in particular, the cost approach and the risk management approach varies a lot across feed yards. So I know very well that none of these numbers match any yard perfectly, but I do think the general trend in where break-even prices and so forth are going is captured by this exercise pretty well. So what I do is I take the monthly Focus on Feedlots survey, which is run out of our Animal Science and Industries Department, to get animal performance, placement weight, death loss, that type of information, and then I augment it with market price information to come up with these estimates of returns. I want to show you in particular, I've highlighted the red. These are projected closeouts from July through April. July is still projected because I don't have the realized performance information yet. There's a 1-month lag in this exercise. But if you get down to the red bars, the Fed prices for September through April closeouts are projected to be 150 or under. If you go to the red bars to the right, the break-even Fed prices, right, what's needed in order to break even, are from 155 to upper 160s. Okay? That is the main reason that the very first column you see is projected losses of $100 to over $200 depending on the month. In short, cost of gain is lower than it once was. It's higher than it was a little bit earlier in the year, right? So we've had some relief, but not a lot of relief on the cost side. There's still a lot being paid for feeder cattle, and we haven't had enough of, right, an increase in fed cattle prices to keep up with that, so you get this squeeze, right? Now, it's very important to appreciate when I push the pencil to come up with these projected -$100 to $200 margins, that's assuming a cash strategy. Because I don't know how to, or I'm unwilling, maybe is a better way to put it, assume a risk management strategy when I do this. So I'm assuming somebody's paying cash for corn as they go. I'm assuming somebody's paying cash for the feeder cattle at the time of placement. And I'm assuming somebody's getting basically the 5 market cash price, right, when they sell. So no price risk management in that story. Somebody that does have those management practices in place is not going to observe nearly the variability that I'm portraying here. Okay? And that's summarized on this slide. Going back to 2002, there's a huge range in this exercise. +$300 to -$300 variability in any 1 month of realized, right, for this exercise returns, with an average return of -$24 and change. So highly volatile. I would submit to you, regardless of your risk management strategy, it's a very volatile segment, right? This probably overstates that volatility because I'm assuming no risk management, so I'm trying to be clear about that. But I do think the general trends on the fact that fed cattle prices have to rally to get closeouts positive is incredibly clear. Okay, that's the main reason to share that point with you. Tomorrow we have the cattle on feed report. Projections are for total inventories to be up 2.6%. I've put a purple star on these 3 slides related to that report just to give you some context of what that would mean. If that is realized, that'll mean there's more animals on feed than this time last year, but still less than history than we've recently had in recent past. In terms of marketings, expectations are for a drop in 3%. That would still be less than last year. That's consistent with just fewer animals in the pipeline. The most interesting one, of course, is what are the placements. That's what most of us focus on, because the cattle on feed number in particular is weighted by the animals we already know are there. The placement piece, you can see a projection is almost 1% increase, but the range is -5 to +5. Those of you that follow this know there's always a pretty good range on what that placement number is. But if, in fact, it is +1%, by definition, it would be above last year, but it's still going to be less than the 5-year average. So the reason I highlight this is, A, the report's tomorrow. For those of you that are in the feedlot industry, you're well aware of that. Monitor it. But it's consistent with we're probably at towards the end of this tight cattle supply part, and going forward, we're going to have more animals showing up in the yards. What are the numbers for projections? LMIC puts these quarterly projections out for the next 6 to 8 quarters, depending on when we do it. There's a lot of numbers up here. You've got the handouts. You'll get them online. But the way this is organized is I've included 2014 up here just to give you some context of where we've recently been. And then 2015, 2016 are up there. The yellow bars are the annual numbers. The individual quarters are up there as well. The purple arrows tell you the direction. So if you don't remember anything else, take note of the direction. Commercial slaughter was down throughout all of 14 and is projected to be down here through the end of the 3rd quarter of 2015 compared to the same quarter a year ago. But I purposely stopped that arrow at the 3rd quarter because going forward, starting in the 4th quarter this year and then throughout all of 2016, we're projecting increased slaughter numbers. So again, to the point on tight supplies, we're to that tipping point of that story is going to start changing. In the middle here, we have dressed weights, and you can see the arrow just goes up. We have an ongoing long-term trend of putting more weight on every animal in the system. The slide's kind of cut off my arrow on the right, but you can kind of see the commercial beef production, so the amount of beef we're actually producing, was going down throughout all of 14 and through the 3rd quarter of 15, but much like how the number of head is going to go up starting the 4th quarter this year, the amount of beef we produce is going to start going up in a year-over-year sense here in the 4th quarter. So I'll say it again, the tight supply story, we're not going to get rid of that in 1 year, but we're at this tipping point of we're going to start increasing cattle supplies and therefore more and more beef production. This is the parallel price slide, and I've added green arrows and red arrows. Maybe that's too many colors to put on this slide, but you can see here I've put the purple line there to cut 2015 in half. So far, basically through 2015, we've had year-over-year increases in prices. Going forward for the rest of the year, so the balance of quarter 3 and all of quarter 4, we're projecting lower cattle prices than we had in 2014. But again, context is important. So those calf prices are projected to be lower than they were in 2014, but probably still the 2nd best on record, right? So when you look to the far right, when you look at those 5 to 6 weight prices, that 251 to 256 projections for the 4th quarter, those are still, if realized, really good prices by historic sense, albeit $30 lower than that number was up there for 2014. Okay? The red arrow goes down because throughout all of 2016, we're basically projecting ongoing declines in cattle prices compared to the same quarter in 2015. So some of what I've shared there with you could come across as bearish. In particular, you add supplies, right? I've probably driven that point home many, many ways, and that's the point. But I'm probably not as bearish as you would think if I stopped right there. I think it's important to have some context of where we're at beyond that. And in particular, if you remember my first slide, I talked a lot about demand, but I haven't talked about consumer demand for the last, 20 minutes, okay? So I think it's important to appreciate that and to appreciate the broader story of the multiple species of meats that are in the story. So I want to spend a few moments with you on that, giving you some context. Total red meat in the cold storage system, right, is up, and this is another point that has some people bearish. So the 2015 numbers, we have a lot more meat in the freezer than we did this time last year. I put up in the box there just some reminders. The main reasons for that are we've expanded production, particularly pork, underneath this slide. There's more pork in the system. But we've also had a host of, let's just call them setbacks on the export front. Logistically, we had challenges in the 1st quarter. The U.S. dollar is high. Avian influenza spillover. There's a host of things that have contracted our ability to export. So we're sending less meat out, and we've increased red meat production, particularly pork, so there's more staying at home. So some of that's in the freezer, okay? That sounds really bearish. But I want to give you some context on some of this isn't new. And this is a bit of a messy slide. I'll partially apologize because I just did it this morning. But this is just showing you the long-term trend in those cold storage numbers going back to 1990. Narrowly, I took every month, cold storage, end of the month inventories, and the main point I want to make is they just increase over time. There's lots of gyrations, right, both seasonally and production underneath that, but the general upward trend is consistent with the fact that we just produce more meat in this country over time, right? The world's growing, the world wants meat, the U.S. produces a lot of meat. I don't think we should overreact to that increase in cold storage number on the past slide when you take some historical context to it. And the main reason it looks really high is because we had really low poundage in cold storage this time last year. So it's not quite as bearish as it looks like when I show you this slide that looks like there's an awful lot of meat there. Yes, there is, but historically speaking, there's not as much as that looks like. This slide right here is one I'm going to transition over to pork and broilers. I already gave you this information on an earlier slide. It's just now it's in a bar chart format. It's quarterly beef production. Again, 5-year average, 14, 15, and the projections for 16. I've put a purple bar on that fourth quarter of 2015 because that's the first quarter that beef production is expected to go up compared to the same quarter a year ago. For pork, that story started the first quarter of this year. So now you can see I've put the purple star on the first quarter of 15. That was a notable increase, right? The reason we have more red meat in the system is because there's a lot more pork that showed up the first quarter this year. And you can see throughout 2015, those are notable increases compared to 14 on pork production. And the 16 numbers are the same or a little, they're close. The rate of expansion is going to be muted some and a couple of those quarters down, but we're going to maintain most of that production spike that occurred here in 2015. Broilers, it's an even easier story to say. We're just producing more broiler meat. Starting the first quarter, more than 2014, and every quarter throughout 2015 and 2016 projections are for more broiler meat to be produced. When you add all that up, you get this slide. So it's total red meat and poultry. There's turkey in this I didn't show you, but it's a minor part of the story. And you can see starting the first quarter of this year, the total meat available, right, that was being produced here in the U.S. was going up, and it's expected to go up more. So again, I've given you more bearish points on more supplies coming, right? But I want to give you more context about why I'm not as worried about that as maybe some others. I made the comment on exports are down a little bit. I apologize, the slides are getting cut off to the right. But 2015 exports are down compared to 14. Hopefully you remember I told you why. The parallel is imports are up. U.S. dollar works that way, right? We actually bring more pounds in with a high U.S. dollar. Challenges in Australia on the weather front. They've been liquidating the herd and a host of those kind of things. The U.S. wants ground beef. We don't have a lot of it, so we bring it in. So imports are up. So the net export story, right, has been adverse, if you like, for the industry this year. I'll go back to this slide. There's a lot of reasons that if you're cattlemen should care about that, but one of the cleanest ways I know to show you that is the value from hide and offal. It comes off a typical fed steer. So most of the value from a hide and offal perspective is an export, non-U.S. arena, and you can see the values this year, they're down $3 to $5 per hundredweight compared to last year, depending on when we peg it. And I would assert that most of that is because of the reduced export volume. So one way to make this point is, in the event we could get exports back to where they were last year, which I'm not here saying we're going to get them back next week, but if that occurred, one of the things you would observe, most likely, is hide and offal values would bounce back up, and that in turn would lead to some higher fed cattle prices, right, because there's additional value in those animals and you get more hide and offal value out of them. Okay? I think it's important to appreciate that, yes, there's been challenges on exports this year, but most people, including USDA long-term projections, expect the U.S. to continue to grow as an exporter of all meats, and they expect the world to want more meat, and all producers, not just the U.S., to be part of that. So I include this slide just to basically plant the seed in your head that once a year USDA puts out these long-term 10-year projections, and they are projecting, they were doing this earlier in the year. I think the general trajectory would be the same if they redid it today, but it'd be muted a little bit because of the U.S. dollar, but they're still projecting notable export growth, and that's a positive for the industry. I'm going to jump ahead to this slide to give you some of the more optimistic points and tell you why I'm not quite as concerned about the supply as some others. I recognize it, but I'm not as worried. Is the consumer in the U.S. has been willing to pay more for beef and pork than we thought they would. I can belabor that in many different ways, but that's the punchline of it. And this is one of the slides that shows you that. Okay? This is in nominal terms, but the amount that's being spent per person on beef, pork, and broilers is going up, and the slope, if you like, on that red curve for the beef line has went up a lot recently, right? So we've been producing fewer pounds and offering less, but the total expenditures went up quite a bit on beef. That's a good thing. There's more dollars in the industry, okay? What I think is an even better story than that is if you appreciate that the portion of disposable income that consumers are spending on that beef is low by historic standards. And I want to drive that point home even more. So the red line here is still beef, and you can see here, 2014, 0.8%, so less than 1% of disposable income was being spent on beef. If you go back real early to the early 90s, that was over 1%. Yes, these sound like small numbers, but for a large country, this matters, right? So even at quote-unquote record level prices, right, consumers have been willing to spend money, partly because it's a smaller share of their total disposable income than it once was. I highlight that because there's some ability to absorb higher prices from a relative income perspective compared to the early 90s. And one of the reasons I think we've realized those higher prices in 2014. Going forward, hopefully, that means they're able to maintain willingness to pay higher prices even as we expand production a little bit, because it remains a small percentage of what their total disposable income is. If you like, it maintains feasibility for us to get higher prices going forward, or maybe have slightly less of a reduction in those prices, simply because we're not asking them to spend 3, 5, 8% of their disposable income on these products. Okay? I want to give you this long-term context. It's the same USDA 10-year projection exercise I shared a minute ago. We have more meat coming in the system. I hope you made that very clear to you. But on a per-person basis, it's not going to be as much as it sounds like. So there's lots of numbers here. I'm just going to jump to the very bottom. In 2024, USDA is projecting that the total red meat and poultry per person in the U.S. will be 215 pounds. Of that, it's going to be a little bit more than half poultry, right, 112 pounds, 103 will be red meat. Take your eye back to 2008, which is the second row here. That poundage was 2016, and a little bit more than 50-50 on the red meat side. So roughly speaking, between 2008 and 2024, we're increasing total production, populations are growing, a host of those things, but the amount of meat per person that's in the system is going to be very similar. Everybody follow that point? So if you keep that context in mind, if we maintain some demand strength, if not improvement, there's a better availability to maintain profitability with expanding supplies than if we were going to really swamp the system and have 250 pounds per person, right? I'm trying to give you some context on there's room to absorb pounds, because in relative history, we had 215 pounds consumed per person. If you go to 2014 numbers here, we were at 202. So part of this tight supply story is there's been fewer pounds available and therefore consumed per person, and we have an ability to get back to where we recently were consuming, right? And underneath these are the projections to expand the herd in all species. Okay? My last two slides are these nasty demand indices slides. I think it's very important to appreciate, and I've told you this a couple times, I'm going to beat it in your head one more time, the role of demand here. Hopefully you accept my assertion that we're going to produce more meat, right? The real question is what will consumers pay for those pounds as we put more in front of them, and where in the world those pounds are going to go, okay? One of the things I try to do is to monitor how strong demand is here in the U.S. So I kick out this all-fresh beef demand index, an annual version and a quarterly version, and there's some really positive parts of this story looking backwards that I want to clarify, and then we'll take it forward. In 2014, I estimate that demand was up 7% compared to 2013. That's the fourth consecutive year, again coming out of the Great Recession, that we've had a year-over-year increase in demand. And what do I mean when I say a year-over-year increase in demand? Really what I mean is the public was willing to pay more per pound than I thought they would. So once I adjust for knowledge about how many pounds are in the system, I have an expectation on what the price that's paid will be. Now where that expectation comes from is academic literature on how price sensitive we think consumers are. So given that expectation, I compare that expected price with what I observe those consumers actually paid. And if that actual observed price is higher than what I expected it to be, then I'm making a statement that demand improved, because the public collectively paid more than I thought they would, right? In geeky econ terms, that demand curve shifted, right, in the story, and that's occurred the last 4 years. To drive this point home even more, numerically at the bottom in 2014, per capita consumption was down 3.7%. So if we remove pounds from the system, because that's what happened in 2014 compared to 2013, and demand holds flat, so if consumer interest in beef and their incomes and all those other things doesn't change, right? So if that's just constant and we remove pounds, we expect prices to go up, right? If everybody wanted the same type of beef, had the exact same willingness to pay, and there's fewer pounds available, price will go up to figure out who gets those pounds. So I expect the prices to go up. Narrowly, if prices went up 6%, I would have said that was the exact amount of increase that offset that decline in poundage such that demand didn't change. That's the indifference point on price increase, if you like, given my recognition of fewer pounds in the system. In reality, prices went up over 11%. So I observed prices went up by 11. If they went up by 6, I'd say there's no demand change. The fact prices paid, right? Nobody made a consumer pay a higher price. They voluntarily paid higher prices, right? Tells me demand improved. Does everybody get that general point? It's a very positive story because it's more money coming into the industry than was quote-unquote expected, given at least past expectations on price sensitivity. Same story holds quarter over quarter. The most recent quarterly version of this is the second quarter, and demand in the second quarter was up 7%. That's 19 of the last 20 quarters we've had a year-over-year improvement. Now, we can talk more about that if you want, but my real punchline is on this take-home summary, and I've underlined it, is the role of demand, how much the consumer values these pounds when we put more in front of them is going to become incredibly clear. My really, really broken crystal ball is 3 to 5 years from now, we're going to be talking about returns in the cattle industry, less about the supply story because we're going to know there's more animals and more pounds, and we're going to be debating whether or not, right, there's profitability because the consumers either stepped away from or changed their tune towards or whatever beef. We're going to talk more about that and less about drought and so forth, because we're just going to have certainty to have more pounds in the system, and it's going to be important to monitor and appreciate how strong that demand is. I can't talk about everything in this kind of a talk. I just put this list up of other issues. I get lots of questions about things in the meat industry, just food for thought, if you like, in our Q&A session or over lunch. Any questions are fair game. And then these slides are on our Ag Manager website. So, Dan, I probably went a little long, but if we have time for a question, I will take it. And as I always say, I take civil rebuttals if anybody has one. Yes, I'm sorry.
Do you think if this is real cool, that we're going to see JBS flood this country importing cattle?
So we're being recorded, so I'll try to answer. We'll repeat the question and try to answer it. Is if COOLA's mandatory country of origin labeling is repealed, do I think JBS is going to flood the industry with cattle? No, would be my answer. There's an effort already underway to bring cattle into the industry. We're already importing from other countries and so forth. That's going on. What I think will happen if there's a repeal is I think the entire chain will operate at a lower cost because there's a cost of being compliant. There's a discounting of different animals depending on the cost that comes with tracking and sorting and verifying right where they're from. And I think it'll just be a more efficient system, but I don't think there'll be any flooding of cattle from any one area. Next question.
You showed a slide that heifer retention, like in the mid-90s, had gotten up close to 6 million head.
Mm-hmm.
Now it's only about 5. Do you think we're going to reach that 6 million head?
Yeah, so the question was, in the past, we had heifers close to 6 million, maybe even over 6 million, and we're quite a ways from that. Will we get back to having 6 million head in the industry? I think that's quite possible. I'm very confident we're going to expand for the next, if it keeps raining. I'm not a weatherman, as Alan pointed out, none of us economists are, per the title of this thing. I think we're going to expand for the next 3 to 5 years because of the cash in the pocket and an interest to repopulate. And if there's one thing cattlemen do on average, it's they do things 2 years longer than they should. Right? I mean, if there was $1 to make yesterday, they're going to do it for 2 more years. Right? So I have a lot of confidence that if the magic number is 34 million head in the industry for beef cows, then I think we're going to hit 35.5. Or if the magic number is 32, I think we're going to go all the way to 34. Because I always describe this as a pendulum, right? Whatever the geeky economist says is the sweet spot is we always go too far both ways, right? We're always moving back and forth, and nothing's as simple as hitting the sweet spot. And one of the ways we're going to do that is to have a lot of heifers added. So I think we're very likely to get to that. That's a very long answer to your question. But. Oh, you're going to ask me more. Yes, go ahead, Dan.
Currency fluctuations are playing havoc with the grain markets, particularly on the export side. When you're looking at meat exports out of the U.S., are there enough other suppliers that can they look elsewhere if they have a bad currency trade out here between the U.S. dollar and what they have, or are there any other places they can go?
Yeah, so I don't know if Dan was mic'd up, but the emphasis of the basic question is what's the fluctuation of exchange rates as it relates to meat? We recognize it on grains, and what are the available alternative suppliers, if you like. On the beef side, Australia is, I'm not going to say flooding the market, but there's a lot of beef on the market because of their drought concerns, and a fair amount of that is coming here, and that's showing up in Asia and other places too. Canada doesn't have the supplies they once did, right? The number of major beef suppliers around the world, the availability of beef is low globally. So that constrains the ability to switch from an exchange rate perspective. That's not quite the same on pork and broiler meat. There's a little bit more of that around the world. You're seeing gyrations of where what countries are importing. Part of that is because exchange rates, part of that's politics. So avian influenza, right? There is no issue from a health perspective about exporting broiler meat, but there's been a notable reduction in broiler exports, right, in response to that. I would argue that those things are a bigger deal in the meat industry right now than the individual exchange rate variability during the year. Just a high U.S. dollar is a real deal, but bouncing around day to day is less of a deal in this story. Yeah. Good question. Means I get to ask you one now. Yeah.
Since the last presidential election, people's real income has actually decreased. You mentioned that the percent of people's income spent on red meat have actually declined. Those two statements seem to be in conflict.
I'm pausing. Actually, they wouldn't have to be in conflict. So the comment was, sorry, I need to repeat this, was over the last several years, you said since the most recent presidential election, there's been an income decline in the country. And then I'm saying that we're actually spending more, right, as a percentage of the income, right, on red meat. You know, go back to that slide just to walk us all through it. Make sure I answer it right for you. Right here. So this is the slide you're referring to. So this is percent of disposable income, and you can see the most recent couple years, particularly the beef line, right, has went up, right? But long term, so you go all the way back, this is way before the most recent presidential election, back to 1990, we were spending more as a percent, right? There's two different things going on. This is a percent of the income. You're talking about total income, right?
Yeah, the amount of income could be going down, but the percentage could change
right.
as a mix.
You could go from $49,000 per household to $47,000, right? That's an aggregate number decline. And yet at the same time, double the amount that's spent on red meat as a percentage of those. So those are both possible. I don't think they're conflicting with each other. Does that help? Yeah. I took a long time to get there, so I'll make sure I understood the question right. But, yeah.
We've got a mic if you want to ask the question.
While you're working on that last one, I'm going to make another tag on to that. Is I don't think the average U.S. person in the meat consumption story is representative of anything. None of us, I mean, you do a random draw of 10 people in this room, and we're not representative of the country, right? There's huge variation in the type of meat we buy, where we get it, and what we pay. Some of us consume a lot more steak than others, some consume a lot more hamburger than others, and so on and so forth. And the reason I highlight that is part of what I think is going on here is a segment of the total population is spending a lot more money on meat than they used to. Not necessarily every single person, right, is up. There's some people that just aren't consuming meat because there's fewer pounds available. So by definition, they're spending a lower percentage of their income, so they're not buying any meat, right? There's other people that might have been income stagnant, but for health reasons have upgraded and they're buying a more expensive meat product, so their percentage of income would be going up. Does that make sense? Yeah. So I don't think they're at odds. Yeah.
A lot of times in these we talk about packer returns. How are they doing?
So the question was, Tonsor, you didn't say anything about packer returns. Why not? Right? Is that more or less it?
Are they robbing feeders to make their own?
Yeah, so the question was, what are packer returns? I am always struggle to answer that question, and I try to be transparent, because the data I have to tell you what those returns are is not as good, or I don't observe the same as I do for other segments. And the main reason for that is we have no good sound estimates of the cost side in the packer. There's gross margin indicators, right? So I have insights about what boxed beef values are, and I have insights about what they're paying for fed cattle and those kind of things. But I don't have good estimates of the cost part of that margin. And I'm not trying to just dodge the question, but I think that's very important, because simply looking at the gross margin isn't sufficient in this story, right? Now, that being said, the gross margins, they haven't been bad over the last 2-3 years, but there's been times when they've been really bad. There's been a lot of variability in those, kind of like my feedlot story. So packers have had challenges at times, but they've had months that were pretty good. The packer is the one, I would argue, is the first one hit by those export challenges. So that hide and offal value decline, they're the one that immediately cares about that, and then they push that back, right, and they beat up fed cattle price and so forth after that. But that immediately squeezes their margin. So the challenges this year on exports, I would argue, have been a real problem for the packing segment in particular. So I don't think there's any robbing of anybody that's going on there. But there's a reason I answered the question the way I did, is I don't have a lot of good cost information to show you a chart that I can defend.
Do you think that's going to get more difficult for you, Glynn, and get more consolidation in the packing industry?
So the question was, is that going to get more difficult for me as we go forward with fewer players, right, in the industry? Maybe. I honestly don't think it's as big of a deal as fewer players per se as the public reporting system that's behind all this. So go all the way back to calf prices, right? We have, USDA Ag Market Service folks, right? They give us price quotes in the Dodge City auction market, for example, around the country. And we've got parallel for fed cattle and so forth. And we've got it for other species and so on. We don't have nearly the same, right? We have food safety monitoring in the plants and those kind of things from a governmental perspective. But the price reporting components, it's all on the meat output side, none on the cost side there. And I think that was the case whether we had twice as many players as we do today or not. I don't think it's driven by fewer players. I think it has to do with the public price reporting system doesn't catch that information. Does that make sense? Yeah. Good questions. And I am going to stay throughout most of the event. If you're shy for the mic and you want to ask me something in the hallway, feel free to do that. Good. Thank you.